Hello everyone, and welcome to the episode 19 of JustDario Cigar Time. Today we are going to talk about the upcoming FOMC, the Bank of Japan rate decision, the quad-witching option expiry the next Friday, President Donald Trump US tariffs warfare, and the risk of a US government shutdown. All elements that combine effectively create the perfect situation for a significant volatility and uncertainty in the coming week that everyone should better be prepared to navigate. The Federal Reserve is finding itself in, frankly, a very difficult situation because even if the US CPI data this week came slightly below expectations, the inflation expectation of the University of Michigan survey for the upcoming years spiked significantly to 4.9%. And fairly speaking, these expectations of direct survey are more aligned to the real level of inflation in the economy, something that public statistical agency like the BLS have been working hard to avoid measuring properly in order to portray an inflation figure much lower than what people are experiencing in their daily lives. Furthermore, all the US tariffs that have been slapped on countries like Canada, Mexico, China, and soon Europe are for sure inflationary. Personally, I cannot understand the various macro analysts and some government officials that keep claiming that tariffs are not going to be inflationary, or maybe they are only going to have a one-off effect. I mean, let's make a simple example here. So today I import a widget to the US for $100, okay? The tariffs is being paid in the moment the widget arrives at the US custom in order to clear the custom and enter the country. 20% tariffs right away implies that the import price goes for $100 to $120. That's a 20% increase, okay? And if you expect that the distributor into the US is going to swallow that increase in price and see their margin being reduced, then you don't know history, because of course every single time that tariffs are being slapped on a specific good, in particular on goods that cannot be immediately replaced for others that are locally produced, then the consumer are forced to buy that good at increased prices. Furthermore, this time around, tariffs are also going to include low price tag items, okay? The one, of more common use in daily lives and more frequently purchased by people. So, of course, the impact of tariffs on inflation is not going to be like 20% or 30% overall. Clearly not, because there is baskets of goods and services, and only a portion of it is going to be impacted. However, there is also a trickle-down effect from categories that are being directly impacted to other categories that are being indirectly impacted. Some categories might even see a decrease of purchases because the consumer might hit the limit. Although in recent times, we saw that consumers are not that willing to cut back any of those purchases, and instead they keep piling up on credit card debt that reached a historical high of $1.21 trillion in the US, on buy now, pay later arrangement, on lease arrangement, and so on. So inflation, because of all this factor, is definitely going to increase. Ultimately, being the inflation a monetary phenomenon, and with all the liquidity printed in the past years sloshing around in the system, we already knew long ago that inflation couldn't be curbed just with few rate hikes that in reality didn't bring interest rates above the real level of inflation in the economy, keeping them at a negative real rate, ultimately continuing to feed the inflation mechanism from a monetary perspective in the system. Reason why inflation slowed down structurally from a number perspective, but if you compound all the inflation from the past years, the loss in purchasing power by the consumer has been epic. And these tariffs are going to come on top of a level that is already high. So beware that percentages are very misleading in this case. So this is one part of the problem for the Fed. The other part of the problem is that, of course, the presidency has been complaining about interest rates of US Treasuries or Fed funds being too high, and this creating problem for the economic growth. Something that, frankly speaking, is debatable, but for sure a problem that the US government has this year will be to refinance a huge amount of debt, trillion in debt, that the former US Treasury Secretary Janet Yellen front-loaded into this year, conscious that all those TBs would have to be refinanced at much higher rate. So what's going to be the impact is on the US government? Of course, all the effort to cut government deficit spending are going to be undermined by higher cost of debt. Personally speaking, I expect no surprises from the Federal Reserve on Wednesday, okay? That will try to keep a balanced stance, because they know that if they change the stance on the economy, that till 1 week ago, Jerome Powell said it was strong. So if they change the stance to an economy that is not strong anymore under the Fed view, so in theory implying they will have to go ahead with rate cuts, they may actually risk a reaction from markets that this time around might not be the same of the previous year, where every time that investors saw at the horizon more helicopter money coming, everything rally. This time around, it might not be the case, because it's clear that the economy is starting to take a toll on the performance of many companies and business. So the Fed claiming that the economy might need like further support might actually trigger a reaction in a stock market that is already fairly unstable. Also, as shown by the volatility level reached in the past trading days. So all in all, I believe that the Fed will try to do its best for this FOMC meeting to be as a non-event as possible, to kick the can down the road a little bit longer and observe the development of the economy and markets. One event surely more relevant this week, where the outcome is actually not that assured as the one from the FOMC, is the rate decision from the Bank of Japan, a central bank that so far is clearly trying to find a very delicate balance between the rate policy that is needed by its own internal economy, that is fighting with increasing and accelerating level of inflation that the economic system was by far not prepared to withstand. For example, this week it has been reported that large unions in Japan have been striking wage increases of roughly like 6%. 2 weeks ago, it has been reported that inflation in some major metro areas raised to 4% and so on. So clearly they are dealing with a prices wage spiral on one front, but on the other front, the Bank of Japan is very conscious that they Fed and they hold the key of all the JPY carry trade leverage that they allowed to be built in the global financial system, with the advantage of both internal financial institution in Japan, but also foreign financial institution. So is the Bank of Japan going to increase rates again, perhaps another 25 basis points to 0.75% in the short term? Personally, I think that they will, in an effort to effectively test the boundaries of the overall equilibrium in the global financial system and see how far they can go before they need to consider alternative measures. However, regardless of this decision in the very short-term part of the curve, one thing is sure. The Bank of Japan is losing control on long-term interest rates of JGB that are now at level that the market saw last times during the great financial crisis. And for a part of the curve, the ultra-long-dated 40-year, the current rates are at all-time high, effectively entering a completely unexplored territories with potential consequences that are very hard to foresee right now, because there is no previous experience of these rates being at such a high level. How the Bank of Japan is going to deal with this situation is perhaps way more important than the refinancing rate they will set at the very short end of the curve, because long-term yields are the major drivers of the cost of funding of all the leverage that has been built in the global financial system through the JPY carry trade. And the Bank of Japan already several times hinted to the fact that they might enhance again a tighter yield curve control in order to manage these rates increase and avoid spikes that can effectively have potential disrupting consequences throughout the global financial system. So clearly, we go back to what I've said so many times already, that the Bank of Japan, even if they're trying to claim they want to normalize their monetary policy, they want to shrink their balance sheet and so on, in reality, the facts are completely the opposite. And as I warned long time ago already, paradoxically speaking, trying to hike interest rates in the current situation they set themselves in after like 30 years of uncontrolled money printing will require even more money printing to cover that higher cost of debt from a government that effectively cannot finance itself in the international market at all. Because, honestly speaking, no foreign investor would be that crazy to invest large sums into a government bond market that not only has significantly negative real interest rates, but is set on a rate path that will impact greatly the prices of those securities, with the potential risk of significant losses to be carried in their book for a very long time till the debt is repaid eventually, if it's going to be repaid. So all in all, I expect the Bank of Japan trying its best, like they did last time, to compensate an action with another and try to be a non-event as well in the market. Because if they do something wrong and something breaks, then the blame on them will be obvious and very straightforward. Something that no government and no central bank wants to be in a situation of. In particular right now, when signs of instability in the global financial systems are increasing more and more. So let's assume that both the Bank of Japan and the FOMC succeed in being a non-event in the middle of the week. What's going to come next is the big quad-witching option expiry on Friday. Assuming that during the week there is not going to be any drama with the US government debt ceiling and the potential risk of the government being shut as a consequence of US Congress inability to pass a bill at the last minute in order to avoid an event that the President Donald Trump already warned that can be significantly damaging and expensive for the US economy. Something that definitely this administration wants to avoid, because paradoxically speaking, it might undermine their agenda that at the moment is set to go against commercial partners that are deemed to be unfair towards the US economy. So we're going to have this quad-witching option expiry. And usually heading into this event means significant volatility. Volatility that I expect is going to be there, in particular because considering what happened to the stock market like recently, many traders and many market makers are finding themselves in a situation where their books are being significantly skewed on the bullish side, and those positions are fairly underwater. When we experience similar situations in the recent times, eventually the market that, let's not forget, are being heavily manipulated, rallied into the quad-witching OPEX with volatility heavily shorted by institutional investor in what is a continuous effort to harvest additional yield from volatility. A trade, that is said many times, 9 times out of 10 is successful, but the one time that is not successful, it can be incredibly disruptive and damaging for portfolio. Volatility shorting that already started this current week, with VIX already coming down from almost 30 all the way down to almost 20 as Friday close. Eventually, the real direction of markets and further signs if we are now in a bear market or still in a bull market will be clear from Monday, when traders and market makers are going to a certain extent, reset their books and position into the next quarter option window. So putting all together, what I described so far will be eventually a very smooth week ahead, with stocks keep rallying and recovering after the S&P 500 and the NASDAQ hit 10% drawdown that is associated with a market correction. And be careful, because this type of rallies in a bear market can be particularly powerful but also misleading, because they can be reverted very quickly, as we saw recently, when effectively like 9 months of gain in the S&P 500 have been dialed back in a span of roughly like 6 weeks. The situation overall is clearly very fragile. So we need all these conditions, plus eventually the US president staying a little bit quiet for a week on the tariff front, in order to sail smoothly into Friday OPEX. Reason why I warn that it's better to be prepared for sudden spike in volatility, because what we experience lately is that there is a clear agenda from the US government to rein in markets and reattach them to the economy, stopping particular stops from siphoning away capital and resources from the real economy that has been particularly bad in the past years, contrary to what was portrayed by the official data. So if all of a sudden we have an escalation during the week, then all the gain can be turned upside down and volatility becomes a problem. And if volatility becomes a problem, then heading into OPEX, many traders and market makers will find themselves with a shorter and shorter window in order to rebalance their book and eventually like limit their losses. And this might even trigger a significant de-risking in the market with a potential waterfall effect and significant losses in stocks that have a very high amount of option positionings on them. Here I conclude with my usual reminder to be careful in this market, to make sure you position in advance, to set your portfolio in a way that it can handle risk, uncertainty, and volatility in the best possible manner into what is clearly becoming a more and more uncertain and unstable market that perhaps just entered a bear market cycle, and that eventually will require a lot of discipline and diligence in order not to lose a significant amount of money in the process, and not having enough resources when at the very bottom there will be significant opportunity to grab when everyone is going to be panicking and position for the next long-term bull cycle that for sure will come in the future. But prior to that, there will definitely be a return to earth of stocks, in particular US one, from the currently inflated levels. Thank you everyone for listening again to me today, for your support on X, for reading and commenting my article on JustDario.com, helping me to improve more and more to provide you with helpful information to navigate the current messy and very complicated financial market, for subscribing to my channel, and for following me on Instagram. I wish everyone a nice weekend and talk soon.